Welcome to Keep What You Earn, your judgment and jargon-free zone for entrepreneurs of all levels. Get ready to learn how to scale your business, save money in taxes, and create a business that grows your wealth. If it feels like the financial side of business is like eating your vegetables, well, then think of this podcast as the ranch dressing to make the process a little more enjoyable. My name is Shannon Weinstein. I'm a CPA and business owner on a mission to simplify money and empower others through knowledge. I hope this episode inspires you to take action, but remember that the information we share is for educational purposes only and is not individual tax advice. Now that we got that out of the way, let's start the show. All right, so you see a lot of good press around concepts like bonus depreciation. You've probably heard of Section 179 somewhere on a tax TikTok somewhere, and they say that you can deduct these heavy vehicles in business and get a write-off. Now, they're not wrong, but with any strategy that seems too good to be true, there usually is a catch. So I want to tell you the real deal behind these deductions, just so that you don't find yourself in a trap. Because most of the time, as you know, these quote unquote tax strategies that come out, they are tax strategies, but they're mostly tax deferrals. They're not tax eliminators. So what they're really doing is procrastinating your taxes and not taking care of them and eliminating them completely. So when it comes to depreciation, the catch is called depreciation recapture. Okay. And if you haven't heard of this, usually comes to bite you in the butt when you go to sell your business or sell your assets. So basically, this is a fancy way of saying that you have to pay the taxes on the depreciation deductions that you took when you get, so that when you get the bonus depreciation, you're really just hitting pause on the taxes, not stop. You're deferring the taxes until the sale of the asset. Now, there's an important concept here called book value, which is not like Kelly Blue Book value, which is not based on, anything on the internet. The book value of your asset, we'll say it's a vehicle, is the value on your books. Now, this equals what you paid for it, less the depreciation you have taken so far at this given point in time. So it's basically what's left of the value based on how long you've had it or what types of depreciation you've taken. So a book value, let's just say you purchase the vehicle for $20,000 and you take the like $18,000 of depreciation in year one, like you accelerate the depreciation, right? Then your book value is $2,000. $2,000, right? So that's not what it's worth, but that's what your book value is. You understand? So market value and book value are not the same thing, but your book value is just what you paid minus the depreciation you've taken. Now, here's what gets tricky. When you sell the asset and you receive money, that money is compared to the book value to figure out if you've made a gain or loss. So if I purchase a vehicle for $20,000, I've taken 18 of depreciation, but that vehicle hasn't really gone down in value and I sell it for 15,000. Now I have a gain of 13,000. See how that works? So what's going to end up happening is you recapture the depreciation and you have to basically pay taxes on that gain because now your book value is down to $2,000. And if the funds that you receive exceed the book value, you're going to have to claim the income, even if the original cost of the asset was greater than what you were selling it for. So even though you bought it for 20, sold it for 15, you have to factor in the fact that you took depreciation on it. And that's a really key element there. So in reality, when you take these large depreciation deductions in the first year, you're delaying it, not eliminating it. And if you're planning on selling those assets in the relatively near future, then this could come back to bite you because you're going to be claiming that income back very soon. Now, this can be especially impactful when you are selling your business, because in many cases, when you sell your business, you also have to sell all of the assets that are on your books. And when you're selling those assets, you have to possibly recapture that depreciation. Hey there, are you on LinkedIn? I love connecting with listeners and other professionals and business owners on that platform. I gotta say, I'm really enjoying it. So if we're not already connected, make sure you send me a connection request after this episode. So if you're selling assets like a fleet of vehicles, big equipment, several machines, this can result in a big tax impact, especially if the assets have already been fully depreciated, either using bonus depreciation or just the fact that they've lived out their full depreciable lives. You really want to consider the impact when you're selling a business. And this is why classifying the sale of a business as a stock sale versus an asset sale are really important. So when you go to sell a business, you have basically a choice between a stock sale where you're selling your shares or an asset sale where you're selling all the assets of the business to another business. Now, it may not make a difference to you right now, but it really does matter because when you're selling your assets, depreciation and depreciation recapture can come back to bite you. So, you really want to be mindful of that and make sure you're talking to your tax advisor if you're thinking of selling your business or if you're even just thinking of selling your assets, selling your vehicle. Before you go and make these transactions, please talk to your tax advisor so you know exactly what the impact is going to be. On top of that, before you take bonus depreciation on these assets, you should definitely talk to your tax advisor of surrounding how long you're going to plan to have this asset. Like if you purchase a vehicle, are you planning on holding it for a while? Are you planning on selling it pretty soon? Do you buy and sell vehicles frequently or buy or sell equipment frequently? That you may just not need to take the depreciation because if you're going to come back and sell it, you may be recapturing a lot of that income anyway. So keep that in mind that the depreciation doesn't just make you eliminate all of that, it is just a pause button. But understanding that concept is so key because it can help you make these better decisions in how you manage your assets and take advantage of tax strategies. Not to mention, it helps you work a little bit better with your professional to plan and make sure they're well informed on what your intentions are around your assets. So I want to make sure you knew about that. And here's what I would do. If I had to give you an actionable tip and you're not sure if this is going to impact you, if you have assets in your business, if you go to your balance sheet and there are assets in your business besides like receivables, cash, bank accounts, you actually have fixed assets like vehicles, equipment, buildings, land, things like that. Talk to your professional, talk to your accountant, talk to your tax pro and say, hey, I heard about this thing called depreciation recapture. How could that possibly impact me if I were to sell a portion or all of my business? Let's talk about it because that is going to be the best discussion to surround how you're going to be handling these going forward and what type of strategy you want to take with these. So if you do have fixed assets in your business, start that conversation as soon as you can. Okay, real talk. Our business can really mess with our emotions and our mindset. Am I right? One day we feel like we're unstoppable, like we could run through a wall, and then the next we want to burn it all down and start from scratch. Hey, I'm with you. A lot of this has to do with how we approach our money. And if you need a quick jolt of mindset habits for the next 5 days to help you reboot and recalibrate, check out my 5-day financial mindset refresh delivered straight to your email. Click the link in the show notes to sign up right now. Thank you so much for listening. If you enjoyed this episode, please leave a rating and review on your podcast platform. This small action goes a long way for podcasters to get our message heard by more business owners just like you. Be sure to check out the show notes for links to information about our guests and ways to get in touch with me. We'll see you on the next episode.